going on, guys? Welcome back to the channel. In today's video, I want to share with you a 1-minute Fibonacci scalping strategy that I've been testing extensively over the past couple of weeks. I ran this Fibonacci approach through 100 different trade scenarios using real market data from the London session all the way through to the New York session, and I'm going to show you exactly how it performed. Now, this isn't some theoretical concept that only works on paper. I'm going to walk you through the complete process, show you actual trade examples on real charts, and most importantly, I'll explain when this strategy doesn't work and how to avoid those situations. Plus, I'll share the full testing results with you, the win rate, the risk-reward ratios, and yes, even the losing trades, because I want to be completely transparent with you guys. Here's what makes this particularly interesting. Because we're working on short time frames during active market hours, we were able to capture multiple opportunities per day. Some sessions were profitable, others had losses, but the overall performance across those 100 trades showed consistent results that I think you'll find quite impressive. Now, before we dive into the details, let me explain why Fibonacci levels work so well in the first place. These levels aren't some magical indicator, they're just mathematics. But the reason they work consistently is because millions of traders around the world are watching these same levels. The 0.5 and the 0.618 retracement levels show up again and again in price action because they represent natural areas of human behavior in the markets. When price makes a strong impulse move in one direction, it rarely just goes straight up or straight down without any pullback. Markets breathe, they move, they pull back, they consolidate, and then they continue. Those pullbacks very often land in what we call the golden pocket, which is that zone between the 0.5 and 0.618 Fibonacci levels. This is where liquidity builds up in the market. This is where institutional traders often enter their positions. This is where retail traders who missed the initial move try to get in. All of this activity creates opportunities for us if we know how to identify and trade them correctly. So let me walk you through exactly how I identify these setups. The first thing you need to understand is market structure. We're looking for clear impulse moves, not small choppy movements, but strong directional moves that break previous structure levels. In an uptrend, this means we're looking at swing lows to swing highs. In a downtrend, we're looking at swing highs to swing lows. The key here is that we need to see a confirmed break of structure. I'm not talking about just a wick that pokes through a level and pulls back. I'm talking about a clean break where the price closes beyond the previous structure point. Once we identify that impulse move, that's when we pull out our Fibonacci retracement tool. Now, let me show you exactly how I set this up on my charts, because there's a right way and a wrong way to do this. And I see a lot of traders making mistakes with their Fibonacci tool configuration. First, make sure you're drawing from the correct swing points. In an uptrend, you draw from the swing low at the start of the impulse move to the swing high at the end of the move. In a downtrend, you draw from the swing high to the swing low. And here's something important. You want to include the wicks in your measurements, not just the candle bodies, because those wicks represent real price action and real market structure. On my Fibonacci tool, I keep it very simple. I have 6 levels marked out: the 0 level, the 0.5, the 1 level, the 0.618, the negative 0.5, and the negative 1. Everything else is turned off because I don't want my charts cluttered with unnecessary information. The only zone I really focus on for entries is that golden pocket between 0.5 and 0.618, and I actually highlight this zone in a different color so I can see it immediately when I'm scanning my charts. Now, once we have our Fibonacci levels drawn and we're watching for a pullback, we need to be patient. This is where a lot of traders go wrong. They try to anticipate the move too early. We need to wait for price to actually pull back into that golden zone before we even start thinking about an entry. When price does retrace into this area, we're looking for specific confirmation signals before entering the trade. I typically use one of 3 approaches. The first approach is looking for continuation candlestick patterns, things like bullish engulfing candles in an uptrend or bearish engulfing candles in a downtrend, forming right at those key Fibonacci levels. The second approach is looking for what I call continuation wicks. These are candles that push into the golden zone with their wicks, showing rejection of lower prices in an uptrend or rejection of higher prices in a downtrend, and then close back in the direction of the trend. The third approach, which is actually my preferred method for scalping, is simply placing limit orders at the 0.618 level. This is a more mechanical approach that removes emotion from the equation. You identify your setup, you place your limit order at 0.618, you set your stop loss just beyond the 1 level, and you set your take profit at a previous structure point. This mechanical approach typically gives you somewhere around a 1.5 to 1.6 risk-reward ratio, which means you don't need to be right on every single trade to be profitable. You just need to maintain consistency and follow your rules. Now, let's talk about the most important rule of this entire strategy: market conditions. Here's the golden rule that you need to write down. Never draw Fibonacci setups in choppy, sideways markets. You need 3 things to be present: a clear impulse move, a confirmed break of structure, and an obvious trend direction. If you don't see all 3 of these elements clearly, you skip the trade, no exceptions. This brings me to the situations where this strategy fails. And I want to be completely honest with you about this because every strategy has its limitations. There are 3 main scenarios where you'll see this approach struggle. The first scenario is when there's no clear trend. If the market is moving sideways in a range, bouncing between support and resistance without any clear direction, you're essentially just drawing Fibonacci levels on market noise. These setups have a much lower probability of success because there's no underlying momentum to support the move. The second scenario is during major news events. When we get high-impact economic releases like non-farm payrolls, Federal Reserve announcements, or unexpected geopolitical events, price can spike dramatically in either direction and completely ignore all technical levels. You'll occasionally see these massive 50 pip or 100 pip candles that blow right through every Fibonacci level like they don't even exist. There's no point trying to trade technical setups during these periods because fundamentals temporarily override technicals. The third scenario where this fails is during low-volume trading periods. Outside of the London and New York sessions, market participation drops significantly. During the Asian session, for example, or during major holidays, you'll see much more sluggish price action, with frequent false breakouts and fakeouts. The setups might look similar on the charts, but the follow-through just isn't there because there aren't enough active traders to push price in the intended direction. So my rule is simple. I only trade this strategy during high-volume sessions, specifically from London Open through to New York close. This is roughly from 3 a.m. Eastern Time to 4 p.m. Eastern Time. This is when the major financial centers are active, when institutional traders are at their desks, and when we have the volume and volatility needed for these technical setups to work reliably. Anything outside of this window, I'm either not trading at all, or I'm using completely different strategies that are better suited to low volume conditions. This discipline of only trading during optimal hours was one of the biggest factors in improving my consistency. Now, let me share the actual results from my 100 trade backtest. I conducted this test over a 12-day period, focusing exclusively on the London and New York sessions. I traded primarily on BTC USD because it has tight spreads and good liquidity, but I also took some setups on other major pairs when the conditions were right. What I found during the testing was quite interesting. First, the win rate came out to around 72% across those 100 trades. Now, you might think that sounds amazing, but let me put this in context. This wasn't just me cherry-picking the best setups. I took every valid setup that met my criteria during those sessions, including some that I was skeptical about. The risk-reward ratio averaged around 1.6 to 1, which means that even if my win rate was only 50%, I would still be profitable over time. But combining a 72% win rate with a 1.6 to 1 risk-reward ratio creates a very solid edge in the markets. Out of those 100 trades, I had 72 winners and 28 losers. The total profit came out to about 8R, which means if I was risking 1% of my account on each trade, I would have grown my account by 8% over that 12-day period. Now, that might not sound like life-changing money, but when you compound those kinds of returns consistently over months and years, the numbers start to get very interesting. What I also noticed during the testing was that the distribution of trades wasn't even across all days. Some days gave me 5 or 6 valid setups, while other days only gave me 1 or 2. There were even a couple of days where I didn't take any trades at all because the market conditions just weren't right. This is an important lesson. You can't force trades. The market doesn't care about your bills or your profit targets. It's going to do what it's going to do, and your job as a trader is to wait patiently for the conditions that favor your strategy. The losing trades were also very instructive. When I went back and analyzed what went wrong on those 28 losing trades, I found some clear patterns. About half of them came from me taking setups too early in the session before volume really picked up. Another chunk came from setups where the initial impulse move wasn't as clean as it should have been. There was some choppiness or indecision in the move that I overlooked because I was eager to get into a trade. And a few of the losses came from what I call revenge trading mentality. After taking a loss, I would sometimes jump into the next setup without properly validating all my criteria because I wanted to make back what I just lost. This is a psychological trap that I think every trader falls into at some point, and it's something I'm still working on. The key takeaway from analyzing those losses is that almost all of them were avoidable. They weren't situations where I followed my rules perfectly and the market just went against me. They were situations where I broke my own rules or rushed into trades without proper confirmation. Now let me walk you through some specific trade examples so you can see exactly what these setups look like in practice. I'm going to show you both winners and losers because I think you learn just as much from the failures as you do from the successes. Before that, I would like to share something with you. Every single day, my team and I break down the markets and share our trade setups inside our free Telegram community. I am talking real analysis from professional traders, not some generic market recap. If you want to see how we analyze these setups daily and get ahead of the moves, make sure you join our free Telegram community. Link is right there in the description. Let's start with a winning trade on EUR USD. This was during the London session around 4 a.m. Eastern Time. Price had been in a clear uptrend, making higher highs and higher lows throughout the Asian session. Then, we got a strong impulse move that broke above the previous high with good momentum. I drew my Fibonacci from the swing low at the start of that impulse move to the swing high at the end of it. Then, I waited. Price continued higher for a bit, then started to pull back. It retraced down into my golden zone right around the 0.618 level. At this point, I placed a limit buy order right at 0.618. My stop loss went just below the 1 level, which was about 15 pips below my entry. My take profit target was set at the next structure resistance level, which gave me about 24 pips of potential profit. That's a 1.6 to 1 risk-reward ratio. Price came down, hit my limit order, and I was in the trade. For the next 30 minutes or so, price consolidated right around my entry level. This is normal, and it's part of why trading requires patience. Then, during the start of the European session, when volume picked up, price started pushing higher. It moved steadily toward my target, and about 2 hours after my entry, it hit my take profit level. That was a clean 1.6R winner. Now, let me show you a losing trade so you can see what went wrong. This was also on EUR USD, but during the New York session. Price had been trending down, making lower lows and lower highs. We got an impulse move that broke below the previous support. I drew my Fibonacci and waited for the pullback. Price retraced up into my golden zone, and I placed a limit sell order at 0.618. My stop loss was just above the 1 level. Everything looked good on paper. Price came up and hit my entry, so I was in the trade. But then something happened that should have been a red flag for me. Instead of rejecting that level and moving back down, price just started grinding higher, very slowly. It wasn't a sharp move, just a slow, steady grind. What I didn't realize at the time was that there was a major news release coming up in about 30 minutes. I should have checked the economic calendar before taking that trade. When the news hit, price spiked up and took out my stop loss within seconds. That was a 1R loss that was completely avoidable if I had just checked the calendar. This is why I now have a rule to always check the economic calendar before entering any trade. If there's a high-impact news event within the next hour, I don't take the setup. It's just not worth the risk. Let me show you another example, this time from a day where I took multiple trades. This was a particularly volatile day during the overlap between London and New York sessions. EUR USD was trending strongly upward with very clear structure. The first setup came early in the London session. Clean impulse move, good pullback into the golden zone, and a strong bounce off the 0.618 level. I entered long, price moved up, and I took profit at the next structure level. That was a 1.6R winner. About 2 hours later, we got another impulse move in the same direction. Same process. Drew the Fibonacci, waited for the pullback, entered at 0.618, and took profit at structure, another 1.6R winner. Then, in the New York session, we got a third setup. This one looked similar to the first two, but if I'm being honest, the impulse move wasn't quite as clean. There was a bit more back and forth before the break, but I took it anyway because I was feeling confident after two winners. This trade ended up stopping me out. Price pulled back into my golden zone, I entered, and then it just kept falling through my stop loss. Looking back at it now, that impulse move should have been a warning sign. It wasn't as decisive as the first two setups, and I should have passed on it. But here's the thing, even with that loss, I was still up 2.2R for the day. That's the power of having a good risk-reward ratio. You can afford to be wrong sometimes and still be profitable. The important thing to understand about this strategy is that it's not about being perfect. It's about having a systematic approach that gives you an edge over time. Some days you'll win more than you lose, some days you'll lose more than you win. But if you follow the rules consistently and maintain proper risk management, the math works in your favor over a large sample size. That's why I emphasize testing so much. You need to know your strategy's true win rate and average risk-reward ratio. You need to know how it performs in different market conditions. You need to know your common mistakes so you can work on avoiding them. All of this comes from putting in the work to backtest and forward test your approach. So let me give you the key rules one more time. Only trade during clear trends. If the market is choppy or sideways, stay out. Wait for impulse moves that break structure with conviction. Use the golden zone between 0.5 and 0.618 for your entries. Keep your risk-reward ratio at 1.5 to 1 or better. Only trade during London and New York sessions. And always check the economic calendar before entering trades. If you follow these rules consistently, this strategy can be a very effective tool in your trading arsenal. The beauty of it is the simplicity. You're not trying to predict where price will go, you're not trying to outsmart the market, you're simply identifying high probability setups based on structure and letting the probabilities play out over time. Now, I want to be clear about something. Trading involves risk, and you should never risk money you can't afford to lose. These results are from my own testing and don't guarantee future performance. Every trader needs to do their own due diligence and testing before risking real money. And that is where Weeks comes in. If you are looking for the best trading platform to execute these trades, I really recommend using Weeks. They are one of the best crypto exchanges out there. And right now, they are giving exclusive rewards to our viewers. Anyone who signs up using our link can claim up to $30,000 welcome bonus simply for trading on their platform. But don't just sign up for the bonus, use it as an opportunity to demo trade this strategy first. Test it using the Weeks demo trading account before using real money to trade. If you found this breakdown helpful, please hit the like button. It really helps with the algorithm and lets me know you want more content like this. And if you're not subscribed yet, consider subscribing for more trading strategy videos. Thanks for watching, and I'll see you in the next one.